The fourth chapter is about foreign exchange risk. Risk is nothing but the variation in the actual result against the expected one. For example, I have expected the rupee value as 74 rupees for $1. But today the rate would be 74.20. So the variation of 0.20 would be called as the risk, or that variation is called as foreign exchange risk. So basically, when our transactions are going to go beyond the national boundaries, our currency would be exposed to different environment, different type of currencies. So when such risks are going to arise, it is called as foreign exchange risk. In the name of foreign exchange risk, we do face different dimensions, and one such dimension is counterparty risk. So in the international trade, we have two types of parties. One is importer and the exporter. Suddenly, if the importer is not able to make the payment for the exporter, then again we have the counterparty risk in the name of default in the payment in the part of importer, and that is called as counterparty risk. So basically, when the parties are not abiding to the terms of contract in the international trade or international financial transaction, we do expose to counterparty risk. Next, market risk. So basically, in the market risk, when we have different types of government policies in different markets that we are going to operate, then it is called as market risk. Next, country risk. So country risk is basically when we have some political problems or some political disturbances or discrepancies, and if we have any social changes or political changes in a country where we are operating, then it is called as country risk. Next, interest rate risk. So basically, interest rate risk is when we have fixed income securities like debentures or loans. If we have invested in such securities in any other country, and if they have interest rate variation, then we are going to face the risk in the name of returns. So that is called as interest rate risk. Next, legal risk. So when we have any legalities and legality related problems or variations or changes in the environment that we are going to operate, then we are subjected to legal risk. For example, in India, we had implementation of goods and services tax, which is nothing but it was a legal aspect. Even though it was a taxation aspect, it comes under the legal system. So that is called as legal risk. Next, transit risk. Basically, under transit risk, we have, when we are dealing with the shipment of the goods from one country to another country, it can be subjected to certain variations, or it can be subjected to damages. So that provision that we give for certain damages in the process of transferring or transportation in the process of shipment, then it is called as transit risk. Next, political or sovereign risk. So basically, in a country that we are going to operate, the government policies are driven by the political system that is present in that particular country. So basically, the political ideologies that these politicians or the leaders bring up in the environment or economy would definitely impact our business on a whole. So that type of risk is called as political risk. Foreign exchange risk, as I have already told, when we have currency rate fluctuations or exchange rate fluctuations, we do face foreign exchange risk. Cultural risk. So when we have certain cultural norms that we have to abide by, then we need to abide by that cultural norms. Say for example, in in Middle East countries, we do face a lot of restrictions when it comes to the societal norms. So we have to abide by it. We can't oppose that particular culture. Next, liquidity risk is basically when we deal with the over-the-counter transactions, we have to make the settlement in the form of liquid cash only. So suppose if I don't have enough cash when I am going to settle down that particular transaction, then I am going to face liquidity risk. Next, economic risk. Under economic risk, basically when we have inability to repay, when we have inability to repay or fulfill our obligations, then it is called as economic risk. Credit risk is where when we are not able to make the payment to the counterparty, then it is called as credit risk. Next, we have foreign exchange exposure. Foreign exchange exposure is nothing but the ability of a company to face the foreign exchange risk. That is called as foreign exchange exposure, or it can also be called as the degree to which we are going to get exposed to exchange rate changes. For example, I have a particular agricultural based industry, and if my entire turnover is worth 1 crore rupees, if I have 80 lakh worth to be expected from the other country, then I have greater degree of foreign exchange exposure. Suppose in the same example, if I have got only 20 lakh worth turnover that I am expecting from the other country or in the form of other currency, then the degree of exposure is comparatively lesser. So that is called as foreign exchange exposure. The degree to which we are going to get exposed to foreign exchange risk or exchange rate fluctuation is called as foreign exchange exposure. And under the types of foreign exchange exposure, we have economic exposure. So basically, when a company is going to have its transaction in n number of countries, it is going to have returns in that particular country. So that returns are nothing but cash flows. As I've already told you, when you have investment done, you are expecting the returns on the investment, and the returns are nothing but the cash flow. So when the firm's present value of the future cash flow, that is, when you have expected some variation in the present value of your returns, then you are exposed to economic exposure. I repeat, when you have your present value of future cash flows to have certain variations, then that is called as economic exposure. And this is definitely going to affect the company's profits, and it can also change the company's competency level. And when it comes to management of economic exposure, we do have different techniques to overcome these type of variations. So one such method is selecting low cost production location. So when you have resources to be acquired at the least possible rate, even though you don't have even though you have to face certain risk, at least you can compromise in the name of cost. So lesser the expense that you're going to incur, the lesser would be your risk exposure. And adopting to flexible sourcing policy. So usually you should not have a rigid outsourcing policy. For example, I am in India, I'm locating my production in India, doesn't mean that I should not outsource my production facilities or production processes to other countries. I have to have the flexibility to change my facilities to different countries based on the situation. Next, making R&D, that is research and development effort for product differentiation. So usually based on the country and the country's requirement, my production process must have flexibility to adapt to the changes that has been incurred or that has been witnessed in different countries. Helping through financial product. So a company should always invest in hedging tools like derivatives, so for example forwards or futures, so that we can lock the resources at one particular price, and we can also make these resources to get into the organization at the best possible prices irrespective of market changes on that particular cost. So these are the different methods of managing the economic exposure. Next, transaction exposure. So transaction exposure has got, a different dimension in comparison to economic exposure. I repeat, economic exposure is nothing but present value of future cash flow, whereas transaction exposure is future value of the firm's domestic cash flow. So which means when our transaction is going to get exposed to different countries, when we have more number of transactions, then definitely our domestic cash flow will also have impact, because we have to get the returns in our currency. So when we have variations on that particular transaction and its worth, then we are going to face transaction exposure. So usually it is going to again impact the profits of the organization. So greater the exposure, greater will be the vulnerability for the organization. So therefore we need to accompany, or we need to have certain methods to overcome this transaction exposure. So again it is categorized into internal techniques and external techniques. Very, very important from examination point of view. Transaction exposure has got two techniques. One is internal technique, external technique. Under internal technique, we have one is method of a particular currency, that is choice of particular currency. For example, if you have your transaction with US importer, you have your entire transaction to be denominated in US dollars and Indian rupee. So if you are an Indian exporter and if your counterparty is a US importer, you are going to expect the receivables or receipts from the US importers in the form of dollars. So instead of getting in the form of dollars, you denominate the entire transaction in one currency. Preferably, if you are an Indian exporter, you would expect the importer to pay the entire transaction amount in the form of Indian rupee. So which means when you choose a particular currency in which your transaction to be denominated, you are going to help to overcome the exchange rate fluctuation, and thus your transaction exposure can be limited to certain extent. Choice of particular currency is nothing but, as an exporter, you would choose one particular currency for the receivables or the payables that you are going to intend to do in that particular transaction. Then we have two different techniques, which is very important even from section A point of view: leads and lags. Lead is nothing but when you are doing certain thing in as soon as possible, that is called as lead. Lag is when you are deliberately delaying to do certain things. So lead is nothing but when you are expecting depreciation in one particular currency. I repeat, when you are expecting depreciation in one particular currency, you make a lead and you will make the payment in advance so that you don't have to face that particular depreciation. So that is called as lead. So when you are anticipating depreciation in a country's currency, you will advance the payment for that particular transaction, and that method of advancing the payment in anticipation of depreciation is called as lead. Whereas lag is where when you are deliberately delaying the transaction or delaying the payment in anticipation of appreciation in the currency, that is called as lag. Lead is delaying in the payment in anticipation of depreciation. Lag is making lead is delay. Lead is nothing but you are going to make the payment as soon as possible in anticipation of depreciation. Lag is where you are going to make the payment deliberately in later stages in anticipation of appreciation. Netting. Netting is where, for example, if you have two particular companies, one is going to make the payment worth 50,000, the other is going to make the same, for the same counterparty, 25,000 it is going to make the payment. So one party is going to make 50,000 worth payment, the other party is making 25,000 worth, counterparties. So the total value of the transaction, from A it is 50, from B it would be 25. So instead of making 50 on a whole by A and 25 on a whole by B, A can make only 25,000 payment to B, so that B can get exposed only to 25,000 worth. So 50,000 and 25,000. 50 minus 25,000 would be 25,000. So the exchange rate exposure would be only for 25,000. So that is called as netting. Next, back-to-back credit swap. Back-to-back credit swap is nothing but parallel loans. So instead of having loans in different countries, you can avail the loans at a pre-decided fixed period and at a pre-decided exchange rate. You can enter into the agreement stating that we will be locking to this particular exchange rate and we are going to settle only for the pre-decided exchange rate. So such loans are called as back-to-back credit swap. Okay, so usually when the companies are located into when two different companies are located in different locations, this back-to-back credit swap would be opted. Sharing risk. So usually under sharing risk, both the parties will equally share the exchange rate fluctuation and thus they are going to reduce the exposure. That's it. So only A should not suffer the variation, or B should not suffer the variation. So both the parties will equally share the variation. So that is called as sharing risk. Next, these are the internal techniques. Now we are going to have external techniques for management of transaction exposure. So usually under external techniques, we have use of currency forward markets, money markets, options and futures. So these four concepts I am going to explain when I start explaining the hedging techniques. Next, translation exposure. So translation exposure is, for example, when you are going to consolidate the balance sheet or consolidate the assets and liabilities of one company as a whole by taking all its subsidiaries assets and liabilities, then you have to take the subsidiaries liabilities and assets in its foreign currency and then you have to convert it into our currency. For example, Infosys is an Indian company. When it is going to consolidate its final balance sheet, it has to take every branch's assets and liability. So it has got its branch even in the US. So when it is going to consolidate US subsidiaries balance sheet to its balance sheet, it has to convert the assets and liabilities of US subsidiary from US dollars to Indian rupee, which means the entire assets and liabilities are converted from US dollar to Indian rupee. So this variation that we expect in the translation from US dollar to Indian rupee is called as translation exposure. So the entire income statements and balance sheet is going to get affected when we are translating one asset to from one currency to another currency. So that is called as translation exposure. So again, under translation exposure, we have different methods: current or non-current method, monetary or non-monetary method, temporal method and current rate method. So which means all the current assets and current liabilities. You people know what current assets and current liability are. That is nothing but any asset or liability which has got less than maturity period of less than 1 year, then we treat that particular asset and liability as current asset or current liability. So we are going to translate this current assets and current liabilities at the current market rate, and rest all the assets and liabilities are translated at historic rate. Under current or non-current method, all the current assets and current liabilities are translated into current market rate, but all the other liabilities and assets, for example fixed assets or any such assets, will be converted at the historic rate. Historic rate is past rate, market rate is current rate. Next, monetary or non-monetary method. So all the monetary items are translated at current rates, and all the non-monetary items are translated at historic rates. So that is called as monetary or non-monetary method. Next, temporal method. Under temporal method, this is similar to monetary or non-monetary method, but the only difference is usually in inventory. You people know inventory is a current asset, so usually inventory has to be translated at current rate, but in this temporal method even inventory will be translated at historic rate. So that is the peculiarity of temporal method. Next, current rate method. Under current rate method, usually they are going to convert all the assets and liabilities as per the said transactions, as per the said rules, but we do have certain assets or certain liabilities, and that is nothing but the stockholders equity. So stockholders equity, it should be converted into at historic rate. So that is called as current rate method. Next, we have differentiation between transaction exposure and economic exposure. So transaction, economic. So as I've already told you, transaction would always be contract specific, and economic exposure would always relate to entire investment. And usually under transaction exposure, the losses is because of the exchange rate, whereas economic exposure would be, you would always anticipate for the investment opportunities, isn't it? So when you are anticipating in all these investment opportunities, you are exposed to economic exposure. So basically transaction exposure is due to exchange rate, economic exposure would be opportunity losses. So, and we have different differentiation. I hope you can also read by yourself. Next, hedging technique. Hedging is shielding ourselves against the losses. So for example, if I am taking an insurance policy for my health, I am shielding myself against my health variations that I am going to anticipate in future. So that is called as hedging technique. Next, why do a company has to go for hedging? Because basically when the company is going for hedging, it is going to have a safe transaction. Even though it is going to get exposed to variation, it can overcome the variation when it is going to go for hedging, and the shareholders can have safety with regards to their investment, because they don't have to have more variations in the expected returns. And also it would help the organization to avail the resources at the best possible prices, and it can also help the company not to get affected for with respect to net present value. So these are the different aspects as to why a company has to go for hedging. Next, hedging of transaction exposure. So again, when we go for hedging of transaction exposure, we can have the same method: internal technique, external technique. The techniques of hedging are contractual hedges, natural hedges. So again, I've already told you, I've already explained you what is natural hedge and contractual hedge. Now I'm going to explain. Forward market hedge. Forward contracts are over the counter contracts. So over the counter contracts are nothing but you are going to have the physical delivery of the goods on the counter. You don't have to deal with the difference amount, you're going to deal with the exact amount. Future contract is the standardized contract, so you are going to deal through the exchange. Whereas currency option currency option, it is going to give the right to execute the transaction. Money market hedge. So basically when we have our receivables or payables that has to be dealt in the money market position, then we are going to take money market hedge. Next, we have natural hedges. Natural hedges, I have just now explained you the natural hedges. So it's the same that we have got under this particular topic. Next, techniques of hedging, operating exposure. So basically operating exposure is also called as economic exposure. So this can also be done in the name of financial strategy, and it can also be done in the name of marketing strategy, then production strategy. So I hope these concepts can also be understood by yourself. It's very, very simple. Next, derivatives. Derivative is a financial product which is going to derive its value from the underlying securities. So the underlying securities can be, bonds or commodities or currencies or interest rates, right? In a simple term, derivative can be explained as a financial instrument which is going to have its value derived from the underlying financial instruments like interest rate, exchange rate, etc., which requires no initial investment or lesser initial investment and settled in the future date. And the examples for derivative would be forward, future, swaps and options. Next, excuse me, advantages of derivatives. So when we have derivatives, we do have certain advantages. One is we are going to shield ourselves against the fluctuations. Disadvantages, it is going to have certain difficulties in the name of different accounting rules, taxation rules, or it can be counterparty risk, etc. And under derivatives we have forwards, futures, options and swaps. Forward is a customized contract. It's a tailor-made contract based on the agreement between the two parties, and it is going to get settled on the future date at a predetermined price. Futures are nothing but it's a standardized contract, and it will be done through the exchange, and it will be settled in the future date at a certain agreed price. Options are nothing but it is the right given but not the obligation. So you don't have to oblige for the terms and conditions, but it is your right to execute the terms and conditions of that particular transaction. Again, there are two types of options: call option and put option. Swaps are nothing but the contract between two counterparties, and it's usually like a barter system. When I have certain need, even the counterparty should also have the need, and when we both exchange our needs, then it is called as a swap transaction. So when two counterparties exchange two streams of payment, for example, I need US dollars, the other party needs Indian rupee, but I have Indian rupee with me and the other party has US dollar. So we come into a particular contract and we exchange our needs. So that is swapping, that is exchange of US dollar with Indian rupee and Indian rupee with US dollar. So this particular contract is called as a swap transaction. And coming towards the individual derivatives, first we have forward transaction. So forward contract, it's a customized contract. I've already explained that. And under forward contract we do have certain characteristics, that is it does have counterparty risk because it is not done through the proper exchange. There is no proper mechanism as to execute the forward contract. So obviously we might face default risk in forward contracts. And underlying assets could be anything like stocks or bonds or foreign exchange currencies, etc. And of course it does have flexibility because I am going to do the terms and conditions as per my need, and the counterpart is also going to give his needs. So we both will come to an understanding and we deal with the terms and conditions based on our needs. So it is going to have flexibility. Settlement, again, it has to be settled through the physical delivery or it has to be settled through cash. And that's the reason it is also called as over-the-counter contract. Contract price, it is not usually available in the public domain. For example, like how you get the stock market update in the public domain, you will not get such updates in the public domain. Next, when it comes to advantages of forward contract, it does hedge our risk to a certain extent, and you don't have to pay any advance payment here to enter into a forward contract. You can just enter into a forward contract without any payment as well. And usually it can be negotiated because it is a tailor-made contract, and we would be having agreed terms and conditions, we would be having flexibility in terms and conditions, so the negotiability would be easier and it would be flexible in the forward contracts. Disadvantages, again, as I've told you, counterparty risk is one such disadvantage, and we don't have any standardized exchange to deal with the forward contracts, and we don't have transparency in the prices because we don't have the list of prices that is available in the public domain. It is not available in the public domain, and therefore we cannot expect a transparency. Next, future contracts, again, compared to forward contracts, future contracts are standardized. So when the forward contracts are dealt in the standardized exchanges like multi-commodity exchange, then it is called as future contract. So future contract is a standardized agreement between two parties, wherein one party will agree to settle the transaction at the predetermined rate on a future date. And again, you have different types of futures. You have agricultural futures, you have metals, you have petroleum. So again, you have financial futures like shares or currencies or interest rate, etc. When it comes to the characteristics, future contracts are highly standardized. So usually they are performed through the exchange. So it is subjected to the terms and conditions of exchange, and it is definitely going to have certain margin. So when you are entering into a future contract, you have to pay some margin amount to the exchange. Only then they will initiate your transaction. And when it comes to future contract, the peculiarity is mark to market. Mark to market is nothing but it is going to change according to the market changes. It is not rigid. It is going to change. Your value of the transaction will automatically get adjusted to the market changes or market prices. And when it comes to advantages of future contracts, it is again one of the risk management tool. Again, it is going to have a guarantee in the settlement of the transactions, and it is going to reduce the counterparty risk. But when it comes to disadvantage, it has some sort of rigidity, and you have to make initial payment. If you don't have the ability to make initial payment, you can never enter into a future contract. So that is one of the disadvantage. Next, types of future contract. You have stock index future, when the underlying commodity, when the underlying asset is a stock index like Sensex or Nifty or Dow Jones Industrials, right? So that is called as stock index futures. When underlying security is agricultural commodities like oil or textiles or any food ingredients, then you have agricultural future contract. Metallurgical future contract is where your underlying securities are precious metals or petroleum contracts. Next, interest rate future contract. When you underlie your security as interest rate, then it is called as interest rate future contract. Then foreign exchange future contract, when your derivative has got its underlying security as foreign exchange or maybe a foreign currency, then it is called as foreign exchange future contract. Components of future contract. So again, under future contract, you have different players who are going to have their role. One is future players. So usually future players it is nothing but a zero sum game. Zero sum game is when both the parties are going to get benefited in the transaction, then it is called as zero sum game. So usually in zero sum game, future players, both the parties are going to get benefited, and the future players are hedgers, speculators and arbitrators. Hedgers, speculators and arbitrators are the future players. Clearing house, so there is one guaranteed exchange or standardized exchange who will be acting as the middleman between both the parties, and that is called as clearing house. Clearing house will become a buyer for the seller, and it is going to become a seller for the buyer. So that is the role of clearing house. It acts as a middleman between the buyer and the seller. Next, margin requirement. It should ensure both the parties, both buyer and the seller, or both the parties who are going to lock their contract, should pay a margin to the clearing house to enter into a future contract. And daily settlement. So usually it is the entire future contracts are subjected to market concept, which means the price of the future contract is automatically adjusted to the market changes and the market rate. So that is called as market or daily settlement. So daily settlement is done on the basis of market changes, or it is done on the daily basis. Then the types of order that we are going to place in the future contract are market order. So when you are executing at the best price available in the market, then it is called as market order. Limit order, when you are going to execute only at a specified price or only at the favorable price to the trader, then it is called as limit order. Stop order, so when you have expected at certain price and you stop that particular order and you execute it, so that is called as stop order. Fill or kill order, so usually usually fill or kill order is nothing but one, for example, the entire order has to be executed and the value of the order is 10 lakh rupees. So up to 5 lakh you execute at one price, and for the remaining 5 lakh you execute at the different price. So that is called as fill or kill order. All or none order. So all or none order is nothing but again similar to fill or kill order. On the open order, that is usually the stock exchange will be opened, right? So it is opened from 9:30 every day. So initially after opening the stock exchange, it is kept open for few minutes and you are executing that particular transaction within that few minutes. So that is called as on the open order. Next, transaction cost. So again, as I've told you, you have to make the margin payment when you are entering into a future contract. So that cost that you incur is called as transaction cost. So again here you are going to make a fee payment or a commission for the clearing house who is going to undertake risk on your behalf. So you make a payment, again you make brokerage charges because you are dealing through the exchange. If you are dealing through the exchange, it has to be through the broker. You can't directly deal with it. So when you are making a payment, commission payment to the broker, then again that is one such cost involved in the future contract. And delivery cost, of course, it is going to have a cost charged even for the delivery of the products. Then tax rules. So when it comes to tax rules, all the transactions, whatever the charges that you get, all the losses or gains, everything has to be subjected to the tax rules. Next, functions of future market. Under functions, price discovery. So one is basically when you have many buyers and sellers interacting with each other, they are going to expect the discovery of the price. Speculation. Again, under speculation we have different types of speculators here. One is scalpers, day traders, position traders, intra spread, inter commodity spreads. So all these are different types of speculations that is done under a future contract. Next, hedging. Under hedging, when you have long hedge or anticipatory hedge, short hedge, cross hedge. So long hedge is nothing but when you have an investor protects against adverse price movements. So longing. What is long? Long is nothing but longing to buy. Short is nothing but sell. So always remember long. Long is when you are anticipating some change in the future so that you are going to buy off today itself. That is called as long. Short is when you are anticipating some changes in future, so you will sell it off now itself and you settle the transaction. So that is called as short hedge. Cross hedge is, when a trader writes a future contract on the another underlying asset. For example, I have already entered into a foreign exchange future. Again, I am going to underline my asset as an agricultural commodity. So that means I am doing a cross hedge. So when my underlying asset is done in the other asset, that is called as cross hedge. Next, swap transaction. Swap, as I've already told you, swap is again similar to future transaction, but here you need to have double coincidence of wants, which means both the parties should have their own needs and the counterparty should have the ability to fulfill the need, right? So that is called as a swap transaction. It's an agreement where the future exchange of one asset for another, one liability for another, or one cash flow or to another cash flow. So one interest rate to another interest rate is being exchanged between the two parties for a specific period at a specific rate. So that is called as a swap transaction. Under features of swap transaction, again I told you it's basically a forward transaction and it should have double coincidence of wants, and comparatively it will have credit advantage because we search for the counterparties who are going to provide us the best possible deal. And of course it does have flexibility because it is between two parties and we can expect the terms and conditions as per the needs of the two parties, and there has to be a necessity or it should be done through the intermediary. So usually it will be done through the exchange only. And settlements, usually they are settled in there would no in a swap transaction there will be no exchange of principal. For example, the principal amount is 1 crore rupees. The other party is paying the interest rate in Indian rupee, whereas its counterparty is making the interest rate in US dollar. So these both parties come into a swap transaction. The principal amount will be there itself. They are not exchanging the principal amount. They exchange only the interest rate payments in this particular transaction. Long-term agreement, of course, usually I told you, right, swap is similar to forward transaction, but forward is usually for lesser time period. It can be for 15 days or 30 days or 3 months or 6 months likewise, but a swap transaction will be usually for more than 1 year, or it can also be for 5 years. So usually long-term forward transactions are nothing but swap transactions. So as far as the characteristics of swap transactions are concerned, I have already explained you who are the parties of swap transactions. So you can write the same points for the characteristics of swap contract. Types of swap, very, very important. You have first interest rate swap. Interest rate swap is where one party agrees to exchange the interest rate payment to the other party. So for a specific principal amount, the one stream of future interest payment is exchanged for the another, and that is called as interest rate swap. So again, under interest rate swap, we have different types of interest rate swaps. One is fixed for floating. I am going to exchange my fixed interest rate loan to floating interest rate. Again, it can be floating for floating. For example, in the US market, I have availed the loan at the floating rate. Again, in Indian market, the other party has availed the loan at the floating interest rate. So the US floating interest rate is exchanged with Indian floating interest rate. So that is called as floating for floating rate swaps. Fixed for fixed rate swap. Again, similarly, I can exchange fixed rate with another fixed rate. Swaption, that is nothing but swap plus option. So when you have the right attached to a swap transaction, not the obligation, when you attach a right to your swap transaction, then it is called as swaption. Next, callable swap. So usually when the swap is terminated before the maturity by the fixed interest rate payer, then it is called as callable swap. It can be terminated even before the maturity. Plain vanilla interest rate swap is where you are going to have the exchange of the periodic payments, but it should be till the maturity date. That is called as plain vanilla swap. You can't terminate before the maturity date. Next you have currency swaps. Under currency swap, one exchange interest payment in one currency is going to be denominated or it is going to be exchanged with the other interest. It is denominated in the another currency. So currency swap is nothing but back to back loans or credit loans, or it is also called as parallel loan. So again, under currency swap, fixed for fixed rate currency swap you have, again floating for floating rate swaps, circus swap. Circus is nothing but one fixed for floating and one fixed for floating. It's a combination of fixed for floating swap. Next, amortizing swap. So usually the entire principal amount is going to get amortized, so that is called as amortizing currency swap. Commodity swap is where one payment stream of the commodity is fixed and the other would be floating, so that is called as commodity swap. Next you have commodity swaps, equity swaps. Equity swaps is nothing but when the return on equity is exchanged with the other returns, then it is called as equity swap. Usually high value transactions or highly risky transactions are done in the name of equity swaps. So risks are borne by the swap dealer. Usually the swap dealer is going to have the intermediary position between two parties. So the swap dealer is going to bear the risk in the settlement of the swap transaction. So the what are the risks that these swap dealer is going to bear? So basically he bears interest rate risk, he is going to bear basis risk. Basis risk is nothing but when you have indices. When you deal with the stock market, you deal with the different indices of the stock market. For example, if you are dealing with Bombay Stock Exchange, you have to deal with Sensex. If you are dealing with National Stock Exchange, you have to deal with Nifty. Again, if you are dealing with New York Stock Exchange, you have to deal with Dow Jones stock indices. So basically, when you are dealing with multiple stock markets, you deal with multiple stock market indices. So dealing with that indices is called as basis risk. Then exchange rate risk. So when you have the variations in the exchange rates that you are going to deal with, again that is exchange rate risk. Credit risk. So credit risk is basically when the counterparty is not able to repay the transaction, or when he is not able to settle the transaction, or when he is doing any default in the repayment, then it is called as credit risk. Mismatch risk. So usually when the right amount is not going to match with the right maturity or right type of loan, then again you have mismatch risk. Sovereign risk is nothing but the country risk. Usually the country where you are going to have your transaction, if they have any exchange rate restrictions imposed on your transaction, then you are facing sovereign risk. Then valuation of swap. Usually the valuation of swap is involved in different dimensions. So comparing the contractual fixed rate to that on a market swap, having again, if you have annuity, it can be done on the annuity basis, it can be done on the discount factor basis. So basically I have already given you the formula for the valuation of swap, that is fixed receipt, that is receipts, that is when you are receiving on the swap transaction, then V swap is equal to V fixed minus V floating. Again, when you are getting a fixed pay in a swap transaction, V swap is equal to V floating minus V fixed. So this is how the interest usually this is how the swaps will be evaluated. And again, when it comes to valuation of interest rate swap, we deal with the same type of methodology. And valuation of currency swap, when it comes to valuation of currency swaps, value of a swap is equal to net present value of foreign bond minus net present value of domestic bond. So here BD represents the bond of the domestic country and BF represents bond bond of the foreign country, right? So next we have valuation of commodity swaps. So commodity swaps are usually settled at a predetermined rate, and again it does have its own advantages and disadvantages. So when it comes to advantages, it is going to expect a long-term hedge instrument. So you have longevity in the hedging instrument. And when it comes to disadvantage, it is always difficult to find the counterparty who have the similar need. So that double coincidence of want, striking the double coincidence of wants and getting the right partner in a transaction, in a swap transaction, is always a tough task. And next you have options. Options, as I've already told you, it's the contract that gives the right, not the obligation, to settle the transaction at a future date at an agreed price. So the date at which you are going to agree that price, or the price at which you are going to agree that particular transaction, is called as strike price, right? Again, you have different types of option. One is call option and put option. The option to buy is called as call option. The option to sell is called as put option. And the different terminologies in the option transaction, or there are three elements in the option transaction. So one is you have call or put option, and you have a premium, that is the value of the option is called as premium, and the underlying commodity is called as the underlying asset. So again, when it comes to the characteristics of options, the buyer has the right to buy or sell the asset, and usually to acquire the right of an option, they have to make certain payment. So that payment that they make to get that right is called as option price or premium. And the exercise price is also predetermined. It is fixed when they are going to enter into the transaction, and it has to be settled at the exercise price only. And when you are exercising that particular price, and it has to be exercised at the set date, and that date on which you are going to settle the option transaction is called as expiration date. And when you have any default, usually options can be over the counter options or exchange traded options. You can expect default in over the counter option, but you can't expect default in exchange traded options. And the types of option, you have American option, very important from 2 marks point of view. American option can be exercised at any time. So any time between the date of purchase and expiration date. So it has got flexibility. For example, I have purchased the American option which has to be exercised on January 1st, 2021. But I don't want to exercise on January 1st, 2021. I want it even before the maturity date, which means I have the right to execute that option even before its maturity date. So that flexibility is given for American option. Whereas European option is different. It has to be executed only on the expiration date. I repeat, American option can be executed even before the maturity date, whereas European option has to be executed only on the expiration date, and we cannot come out of the European option in between, right? Next you have call option. When it gives the right to buy, that is right to buy a particular asset that is underlying the option, then it is called as call option. And when you have when you have given the holder the right to sell the underlying asset, then it is called as put option. So right to buy is a call option, right to sell is a put option. Real option is again right, when you have opportunities in different types, then it is called as real option. Then vanilla option is nothing but a standardized term, plain vanilla option. It is similar to your European option. Exotic option is when you have more complicated terms and conditions, when you have various combinations of options, then it is called as exotic option. It's a complex option. Index option, when you have financial derivatives derived in the name of stock indices, then it is called as index option. And stock option is nothing but when your underlying securities have got any sort of securities, then it is called as stock option. Then trading of options. So when it comes to trading of options, you have two types. One is over the counter, then exchange listed. So over the counter is where you are going to directly deal between the counterparties, and the brokers usually bring the counterparties together on a single platform and settle the transaction. Exchange listed. So when the options are listed in the standardized stock exchanges, and when it is executed through the proper exchange flows, then it is called as exchange listed options. And when it comes to valuation of currency options, usually when you have a call option or a put option, you have to check with the strike price and the market price. When the strike price, the price at which you would have entered, right, the price at which you are going to settle the transaction is called as strike price. Market prices on that particular date, when you are settling the transaction, what is the market value? For example, I have entered into a contract to settle the option at $1 is equal to 74 rupees, and this is going to get settled on January 1st 2021. On January 1st 2021, the market price would be 74 rupees 50 paise. So which means the strike price is less than the market price. So when the strike price is less than the market price, you are going to take put option. And when your strike price is greater than the market price, you are going to go for call option. And that is called as the mechanism of the valuation of currency options. So under advantages and disadvantages, again, when it comes to advantages of trading options, it is going to give flexibility. You can expect leverage, again, that is, you can expect benefits. Again, you can also expect a reduction in the potential risk that you are going to face. Whereas under disadvantages, again, you are going to face disadvantage in the form of cost of transactions. Again, if you have over the counter option, again, you can expect default in the repayment. Again, if you don't have a proper exchange through which you are going to settle the options, again, your entire transaction is going to have the risk. So on a whole, foreign exchange risk management is basically all the techniques that a company is going to undertake to reduce its exchange rate exposure and improvise its profitability and help itself by increasing the competency level and reducing its vulnerability towards the risk. So in a nutshell, foreign exchange risk management is going to be the tools and techniques a company or a country is going to adopt to reduce itself from the vulnerabilities in the foreign exchange market or exchange rate transactions or exchange rate fluctuations. Thank you.